I'm Lindsay Williams in Cape Town, and with me in the studio is Jan van Niekerk and also Piet Viljoen, both from RECM. One is the chairman and the other one is the CIO, and we're talking about the global fund. Now, gentlemen, the global market over the weekend went a bit berserk, didn't it, because of the, Jan, I'll start with you, the 295,000 jobs that were created by the United States of America. 5.5% I think was the unemployment rate, the lowest for 7 years, and essentially we've got full employment. Now, how does this change things, apart from the fact that it shows that apparently quantitative easing in the US has actually worked?
Yeah, look, I think there's a few comments. The one is that apparently the Americans are spending themselves out of their problems. Again, if you look at the policy response that the US took versus Europe, austerity on the one hand and quantitative easing. But the overall thing I think you should read into that is that whatever the authorities are doing, they are fixing the US economy, and that is still the driver of the global economy, and things tend to look to be doing better all the time.
Yes, indeed. I mean, Piet, I know you're not so much into the macro story at RECM. You're more into the stock valuations, etc. But you have to look at the fact that the US economy has been fixed, and it's the biggest economy in the world, and therefore it will filter down to the stocks that you look at.
I guess so. I guess that's a fair comment. The economy is getting stronger, not weaker. That is why there's a lot of talk about the interest rates that possibly eventually could start rising, and that's why the market, I think, has reacted so negatively in terms of a lot of the stocks going down. But that's all part of the rehabilitation process, if one can call it that. And the economy is getting better, and that is net good for the global economy.
Yeah, and do you think that this is something that sort of vilifies your approach to deep value investing? I mean, the fact that the world's biggest economy is going to do well means that the stocks that perhaps have been a little bit beaten up over the last 3 or 4 years are going to start to get back to where they should be.
Yeah, look, I think if you think back 4 or 5 years ago, many of the US stocks, the names we held in our portfolio, priced in a future which was a lot more dire than what we're expecting at the moment, which confirms to us the fact that it is very difficult for anybody to consistently predict macroeconomic outcomes and invest successfully onto that. So yes, and I think if you look at the holdings in our portfolios at the moment, a lot of those are pricing a very bad outcome for the world economy and for global growth, yet you see numbers like this coming out of the US showing that at least the biggest driver in the world economy is recovering at a rapid pace.
Let's have a look at your top 10 holdings, Piet, in the RECM Global Fund. Number 1, Tesco PLC, beaten up. Horrible. People hated it for the last 2.5 years, I think. Anglo-American PLC, Anglo-American Platinum, and the list goes on. Justifies some of the top 6, for example.
Yeah, so I guess we are value investors, so what we consistently look for at all times are assets that are priced below their intrinsic value. In other words, below what their the present value of their future cash flows would dictate. And that gives our margin of safety. So we're not forecasting a rosy outlook for the UK consumer sector and therefore we buy Tesco. We say Tesco is going to earn more in cash for its shareholders than the current share price is discounting. Yes. And that's why we're buying it. So we don't have a view on the UK economy per se. It's just that the current share price is far below what a reasonable outcome would be for their cash flows.
Okay, something like Anglo-American PLC?
Similar situation. Anglo-American PLC is a mining house conglomerate that owns stakes in diamond mines, in platinum mines, and so on. And we think that through time, its assets actually generate good returns on capital. And at the moment, the share price is not reflecting that at all. It's reflecting the current poor state of the global economy. And we think that the only thing you can say about economies is sometimes they go up and sometimes they go down. Sometimes they expand and sometimes they contract. We just don't know when, but we know what follows a contraction is expansion, and what follows an expansion is a contraction. Currently, we've been in the contraction phase, and we think somewhere in the future, in the not too far distant future, we're going to go into expansionary phase, and companies like Anglo-American will benefit from that.
There's an article on CNBC.com, Jan, that talks about exactly that. I mean, it says that lorry drivers, truck drivers in the western part of Australia were earning $100,000 a year. when the commodity prices were at their peak, and now they're saying that commodity companies are even cutting out steak sauce in their lunches. So it seems to me that when you get the US economy doing what it's doing, when you get commodity prices so beaten up, and when you get these headlines, something is about to change.
Look, the only bit we probably don't know about is it's about to change, but all the fundamentals are working in the direction to cause commodity prices to start rising at some stage, and that is all the way from capex spending, which is being cut not only in the energy sector, which is quite visible at the moment and quite topical, but in many other parts of the commodity complex, capex is being cut. If you speak to company management of the large mega multinational mining companies, Rio Tinto's, Anglo American, Billiton, the rhetoric coming out of there is that we are running these businesses for optimization of cash flow, optimization of returns on equity. We're not spending money on new projects anymore. We can just, through brownfields, increase the volumes out of our own projects. It's a lot cheaper than buying anything else. So all the actions employed by the new management in those businesses are shareholder friendly. And that means that the supply of commodities in time will come in line with the demand, and the prices will revert to sort of the normal levels that they should be.
So let's hope so. It's been a long wait, and you have to be patient as a deep value investor, Piet. So tell us more about the fund over the last few years. Hasn't been fantastic, but on the other hand, it's poised for greatness from what I hear.
We'd like to think so. We think the stocks that we've invested in are actually fundamentally low risk, high return opportunities. These assets are all priced very cheaply, way below intrinsic value. And if something right happens at some point, these stocks will do very, very well. And if nothing good happens, then I don't see them going down very much from these sort of levels, because they are sort of rock bottom at this point. So for us, it's a great scenario of a low risk, low downside risk, high potential return situation. We've created a portfolio of different situations in the UK grocery market, in South African mining, in North American oil majors. We've created a basket of cheap situations. Some of them are uncorrelated, and we think the outcome of such a portfolio is actually quite exciting.
Yes, they are uncorrelated, but where there is a correlation is to do with the resources, Jan. And of all the ones that your colleague has just outlined, which would be the one that you would say, would it be the diversified miner, or would it be the single resource miner, for example, Anglo American Platinum? So PLC versus Platinum.
Are you asking to pick one of those?
Yes.
Look, there's a reason why we put together a portfolio.
The most enthusiastic about.
Look, the ones with the individual most upside are probably the single commodity businesses, because those are priced for absolute failure at the moment. So when anything goes right, those will do much better.
Yeah.
But I think, as Piet highlighted, it is important to look at the entire portfolio. We also hold around 25% in cash, which gives you an indication that we've been struggling to find a lot of cheap assets in many other parts in the world, and therefore, as those North American names that we've owned for many years have come to our fair prices, we've been selling those, and those assets have been deployed into other parts of the world, which is unloved at the moment.
Yes, indeed. And if you have a look at what we've been talking about, and again, I know you don't look at the macro side of things, but what we saw on Friday when it came to the US jobs numbers, I mean, the dollar went through the roof, the rand went through the floor. Is that anything that you ever consider when it comes to the RECM Global Fund? I mean, do you say to yourself, well, the rand suddenly gone from 11.80 to 12.10, which it was on Friday at one point?
Yeah, look, that daily move, that's what is that, about 2 to 3% move, that's actually negligible in the bigger scheme of things. What we look for, we definitely look at currencies, but we look at their purchasing power parity valuation levels. So when a currency is very far out of line with its purchasing power parity value, then we will possibly take a position in it or calculate it into our intrinsic value for the assets which operate in whichever country's currency is out of line. So at the moment, we think the rand is probably a touch too weak against the dollar, and the dollar is probably getting on the strong side, but there's not massive divergence from underlying intrinsic or fundamental value in the currencies. I think one should just bear in mind, although the rand weakened against the dollar on Friday, it did not do so against the euro and the pound and other currencies. So what happened on Friday was dollar strength. It wasn't really rand weakness. In fact, I think the rand is stronger now against the euro, quite a bit stronger now against the euro than it was a year ago.
Talk about the RECM Global Fund performance over the last couple of years, if you would, Ian, and what you expect, what you're hoping now. I think that Friday was an inflection point, personally, and I really think that funds like yours will do well. That's my opinion, not CNBC Africa's opinion. But last couple of years, how's it done?
Yeah. Look, I think what we found at RECM is there's a divergence between how our global funds have done, which we think have done really well over time, versus the way deep value investing has behaved in South Africa. So, we're quite proud of the returns that we've generated on our global funds and the way we've, gone about that. To perhaps latch on to your earlier point, the last time we had a specific view on a currency, was around in 2008 and 9 when we had more US assets in our portfolio. This is a dollar-based fund, so it's not a rand-based fund. So we don't necessarily have to take currency views away from the rand there. But our portfolio had significant US dollar exposure. That exposure has been reduced. So we're comfortable and very proud of the returns that we've generated in our global funds. We understand that the value cycle, in South Africa have played out, slightly differently. But we've done this and we've seen these cycles many times in the past, and we're comfortable that this one, as you point out, will come through again.
Of course it will. The Tesco, Anglo American Platinum, BP, etc. Any chance that you will be tweaking this portfolio in the future? Are you happy, given what we've just been speaking about, both macro and micro, that this is a portfolio that's going to stick for quite a while?
As things stand, we're very happy with the portfolio, so we're not tweaking it, but we do react to price movement. So when the price of an asset goes up a lot, in other words, as the margin of safety declines, as prices go up, then we'll probably reduce positions. And as prices decline, in other words, the margin of safety opens up, then we'll probably increase positions. So we react to the cards we dealt. We don't try and anticipate the cards being dealt. We react to the cards we dealt and transact based on the margin of safety that is presented to us.
Jan, fun question. Anything you're watching at the moment, is there any sort of stock or any sort of geography, any sort of sector that you're looking at and saying, when it gets here, I'm going to pull the trigger?
Look, the area where we're finding it more difficult to find cheap ideas is the US, as we highlighted. The areas where cheap names are coming out are in emerging markets more and more. Brazil, for one, the currency has already fallen quite a lot, and there are many names in the Brazilian indices that are looking cheap to us. We hold some names in Russia already, and there's a lot of bad news, and that means that some assets become cheaper over there as well. So those would be the areas that we've been looking at and where we own some names in the portfolio already to add to.
Yeah, Russia, in fact, is in local currency terms, the best performing stock market in 2015. Gentlemen, thanks very much for your time this evening. Piet Viljoen is the chairman of RECM, and he was joined by his CIO, and that's Jan van